Hello, and thank you for joining our webinar on early stage corporate debt solutions. My name is Jimmy Nguyen. I'm a financial analyst at Capital Advisors Group, and I will be your host today. Sitting with me and covering today's topics are Stefan Spacek, Executive Vice President, Director of Debt Placement, and Richard Bowman, Senior Vice President, Founder of Debt Placement. A little background on Stefan. Stefan Spacek supervises business development in the New England and Central regions. He also oversees the company debt consulting business. Since 2010, Stefan has also overseen the debt consulting business in the East Coast and the Midwest territories. He joined Capital Advisors Group in 2006 as the Director of Marketing, overseeing the company's brand strategy, product positioning, content development, web strategy, advertising, public relations, and direct marketing. Rich has over 30 years of experience in consulting, commercial lending, equipment leasing, most notably in the high technology and life science industry. In 2003, Rich founded Debt Advisor Group, the debt consulting arm of Capital Advisors Group. Currently, Rich focuses on business development on the West Coast. Now, before we get started, there are a few housekeeping items I would like to cover. You'll notice an area within the module on your screen where you may submit questions at any time during the course of the webinar. Steph and Rich will review these questions and will answer them during the Q&A at the end of the webinar. We will also be sending out an email after the webinar with a link to the presentation and contact information for Rich and Stefan. Now, I'll hand over the presentation over to Rich Bowman. Rich, take it away.
Thank you, Jimmy. I'm going to go over first what our agenda will be today about Capital Advisors Group, who is CAG and what do we do, why corporate debt solutions with a focus on early stage borrowers, that particular niche market, is debt financing right to your institution, which it can be key particularly for growth capital companies and their forward moving capital structure. Then we're going to go on and do a case study, the deal overview that Stefan's going to focus on. And finally, we'll talk about Capital Advisors Group's process, focusing on runway extension and competitive sourcing. We'll move on to the next slide now and talk about Capital Advisors Group. Prior to joining CAG, I spent 25 years as a lender, and had witnessed, mostly in the mid-'80s and '90s, and had witnessed many brokers and intermediaries who basically were just fee-driven. And it was concerning to me that they weren't always working in the best interest for their clients. So when I witnessed Capital Advisors Group working as a registered investment advisor, who's always required to act in the fiduciary best interest of his client with common goals and interests, it was something that sparked my interest and gave me a much better sense of what we might be able to create at Capital Advisors Group on the debt side. In 2003, we began with, since then, we've advised on over 448 companies for almost $2.5 billion in business. We've reviewed over 1,200 term sheets, which really gives us probably the biggest data points of anybody in the market. Think that the lenders really only see their own debt sheets, and we're getting to see the entire universe of debt sheets that are out there. We have somewhere around 55 to 60 years of experience on our team. And in the bidding process, we have been using mostly 50 lenders, but now that we're expanding our offering with some of the new products that Stefan's going into, we're looking at upwards to 100. Why corporate debt solutions? Debt is an important part of every company's capital structure. To be implemented properly, you really have to get the structure and the timing correct for it to be key. Debt is always less dilutive than ownership positions in equity. Most venture debt deals have an equity kicker in them, but it usually amounts to less than 0.5% of the company, where equity deals usually lie in the 3 to 5% range. Properly structured debt can extend cash runway for companies. We feel that this is really the most important component of what we're looking at. So we always are very focused on whatever runway that these deals can create. deal we do, we estimate a runway extension. A consultant who understands early stage debt markets, knows suppliers. Our unique knowledge and understanding of this market and the data points allows us to really be a value add in working with these companies. I'll pass it over to Stefan now and allow him to pick up the ball.
Thank you, Rich. So to be clear, I think Rich has stated it already, but we're an advisor in these transactions, and our goal is to help our clients get the best deal that the market can offer. So debt's become much more popular form of financing, especially since the financial crisis of 2008. Many more lenders now than there were prior to the crisis, and which gives a lot more variety in terms and structures and flexibility that these lenders can offer early stage companies. So it's really been an interesting time to be focused in this space and advising on these types of transactions. And we want to make sure companies are using it properly. And one way we do that, especially early on in speaking with companies, is to provide a list of questions to help them understand, how debt might best suit the company. So we want to figure out specifically how debt can benefit the company from a broad view. So, just adding debt to the balance sheet to have more, quote unquote cash is not necessarily the way to go. We tend to not to recommend that be the approach. We really want to help companies grow in some way or reach critical milestones that they otherwise wouldn't be able to. How much is it going to take to get there? So that's a big part of how we come in early in the process to help companies understand exactly what the capital structure might need to look like. We're going to show an example in a little bit of how we did that for a company that we helped raise money for last year. And it's a good example of really figuring out the right capital structure to get a company to a certain milestone. Is it going to be near-term operational or capital expenditures, or is it really looking at that longer-term cash runway extension or helping companies grow into new markets or whatever else? So we really want to get a good sense of how it can help. And then how sensitive are investors or management to dilution? Typically, these transactions come with some sort of equity component. Granted, it's far less equity than would come with, or far less dilution than would come with an equity round. And there are ways to really mitigate some of these equity kickers nowadays. As I said, there's more lenders with different structures. So in some cases, we can get deals done without warrants at all. Not that it's entirely common, but because there's more lenders out there and more competition, they're trying to get creative in how they can provide this type of financing. And then also understanding, what type of structure would be most appropriate. And that would vary depending on the phase of the company, early growth stage. For healthcare companies, are they clinical stage or commercial? That helps us determine the appropriate lenders. And then one of the sort of prerequisites for a straight cash burning company is that the company have at least 12 months of cash on hand as it's burning down. And then who the current investors, top tier, deep pocketed investors tend to get favorable interest from lenders who maybe want to work more with them or work with their other portfolio companies as well. Certainly not a requirement, but it does help. And then how much equity is into the company, how much is left? If it's an A round of $10 million and there's a small amount of equity in there, not necessarily with top tier investors, it's a totally different story. If it's a C round of $40 million and there's $70, $80, $90 million into the company already, because obviously there's some history there. And a less of a likelihood that the investors would let the company go at any near-term future stage. And then again, we'll bounce back and forth between kind of healthcare or non-healthcare technology examples. But for healthcare companies facing regulatory risk or clinical trial results, and without a deep pipeline, lenders get concerned about what they call binary risk, a thumbs up or a thumbs down from regulators on a technology that's being developed. So that could be an issue. And also intellectual property or in-licensing of certain technology and how easy it is to, potentially get access to that IP should there be issues in the transaction. So those are all sort of a broad list of questions that helps us define, how suitable debt might be for a company after we first start speaking with them. So I'll pass it back to Rich here just to talk about how things have changed in recent history.
Thank you, Stefan. As I mentioned before, I was actively involved in the equipment leasing markets in the 80s and 90s, and these were really the earliest lenders into this market. Those deals in those days tended to be very formulaic. As a matter of fact, how they were structured, the lenders would put them together, was to go out and buy an HP 12C, and they could run all their cash flows very simply on those and find out what the IRRs and some of the other important metrics were. As it became more sophisticated after the internet bubble burst in the early 2000s and coming up to today, the lenders have really made the terms and conditions far more complex. I don't know if they're doing that to put a little mystery around what they do, or if they're doing that because they feel that they can be more competitive or they can provide better services for the companies. But you see things such as multiple tranches, facility fees, a lot of balloon payments which tend to help cash flows. Prepayments have become very important for companies. The fees can vary for seasonality or cyclicality in businesses. The interest rates can vary. They used to be always fixed. Nowadays, today, they tend to be floating off different indices, whether they be prime rate or LIBOR. You look at paid-in-kind interest in some of these more complex deals. There's not only is the warrants used for some of the equity components at the end of deals, but success fees are longer. You have longer interest-only periods, particularly in the last 2 to 3 years, that go out anywhere from 12 months all the way as long as, we've seen them as long as 24 and 30 months. There's revenue sharing in some of the new products, particularly on the healthcare side. And then finally, there's always that equity kicker that Stefan and I have alluded to earlier. Next, we'll take a look at some of the other uses of funds. These are some of the way that this new capital, how companies put it together. So the first bracket that we're looking at here really is in the biotech pharma area. They can look at it for expansion capital, put them through all their clinical trials. They're looking basically to expend this in the research side to get out as far as they can to get them to the additional data. You can look at equipment. They can look at equipment leases and loans. And again, this was the really early stage. We don't see as many of those today as we had earlier. Refinancing activities. They refinance it now and then hit another critical point, and they'll take a look again to see, or after another, say, a Series A to a Series B or an IPO, they look at refinancing as each one of these, the capital structure within their company changes. The most common use today is what we'll call growth capital, which means the company can use it for any source that they want. We used to refer to these as airballs because there's no specific underlying capital. It's a general lien against the assets of the company, such as the cash and really the intellectual property is what they're looking at. We again emphasize here the extended runway, and if that extended runway can get you to another point in the firm where it might increase the valuation of the firm. And then on the general downside, we have huge things leading up to IPOs, and runway extension. These are all things that we have to take a look at and consider when we're looking at the general financing. I'll pass it back to Stefan now on the next slide.
Thanks, Rich. So this, now that we've set the stage on the market a bit, this piece here gets us into an overview of an example of a deal that Jimmy, who you heard from earlier, and I worked on last year in 2017. Our latest white paper is a commentary on stakeholder alignment. So we think about the stakeholders in this process. So you have the company and management, you have the investors, and you have the lenders. And this, just to be clear, this is a clinical stage healthcare company in this case. So obviously no revenue or any other cash coming in. So they were 100% backed by their investors. But was a great example of stakeholder alignment, and it really made the process very efficient for us to have everybody aligned in terms of what the company needed, and we were able to get the deal in place very quickly. So this slide here talks about how each stakeholder needs to have a role in the process. So the investors, they need to embrace the vision for the company in terms of where it needs to go and how it's going to get there. I have been in cases where, investors and management might have a different sense of how much debt it would take, or the size of the round, and the investors might want to put in more equity. The management and founders might want to do more debt, and there's some disagreement there and misalignment, and that can really slow things down. But in this case, the investor was very much aligned and embraced the vision that was passed through management. And so the management their job at that point, once the vision is aligned with the investors, is to communicate. So every company has a story to tell, and what we try to do is help our clients shape that message. What's that story going to be, and how is that going to unfold to the lenders? Because founders and management, the best thing about doing these deals for early stage companies is there's so much enthusiasm around the technology or the product or what the company is trying to do that the story really resonates in most cases. So management has to communicate that as they speak with the lenders. And then to complete the circle, lenders really, to get the best kind of terms, they need to aspire to work with that company, to work in the industry the company's in, or to work closely with the investors in hopes of forging relationships and perhaps working with more of that investor's portfolio companies. And so that kind of completes the circle for the ideal deal, for lack of a better word, but and how to get all the stakeholders aligned in the process. So to dig into it a bit, so this was a clinical stage biotech with a strong investor syndicate, and they wanted to supplement an equity raise that would get them through a potential acquisition date in about 12 to 18 months away. So this was an interesting case because all we knew was that they were going to be raising $11 million in equity. And then the company came to us and said, well, what's it going to take to get through this inflection point, to get the data that we need to potentially get acquired by a large pharma partner that was also involved in the process. And so it set us off on a course of really figuring out the appropriate capital structure. The equity investors, the VCs, were on board with putting in more equity as needed, and we were just there to tell them how much debt could be supported by the equity they were willing to put into the company. So we had this company, the primary institutional investor, who were the VCs, the venture lender, but we also had this large pharma involved. With that in mind, with the knowledge of this 11 million that was coming in, we set out to provide a couple of scenarios where it would provide them the ideal capital structure to get to where they needed to go, which was really the January 19 timeframe. So you can see on this model that they had the 11 million coming in near term, and we felt that could be supported by 7 million in debt at the time. And then within the next 6 months, we suggested that if the equity investors put in another 6 million, and then we tacked on an additional 3 million debt round for a total of 10 million in debt, that would take them out to that January 19 inflection point. So this is one case where we gave them a look at a suitable capital structure scenario with debt financing to get them where they needed to go. And then on the next slide, the second scenario just shows, what if they did that all at once? So right now they would have to, at the earliest stage, they would upsize that round to 18 million, and then they could take down 10 million in debt, which would again get them out to that January 19 inflection point. So they chose the first case, and for a couple of different reasons. Based on the numbers here, it was $1 million less in equity that they needed to raise, and by the two tranche scenario, it also allowed the company to take down 7 as opposed to the full 10 on the front end, and then kind of do a check-in 6 months down the road and see, were they on track? Would it make sense to continue on with this debt financing and the combination of debt and equity? And it gave them a look without having to take down the full 10 on the front end. So these are conversations and considerations that our clients oftentimes have as we think through structural piece on the front end of a transaction. So they chose the 2 tranche scenario, and then we moved forward. And on the next slide, these were how the investors were aligned. So they had struck a deal with large pharma, which was really a build-to-buy type scenario where the company just had to reach these certain clinical milestones, and once they did, then there was a buyout option. And so the more of these milestones they hit down the road, the better the buyout option would look like. So they had these predetermined terms based on those milestones. And the investors were really interested in investing, minimum capital for maximum ROI. They could save the additional equity, get themselves to that buyout decision, without using more money out of the fund that they could use elsewhere. So they were willing to support the company to whatever extent necessary, but they were also interested in this debt financing to help them save the additional equity. And then, the company was very much aligned because the investors had an operating partner as part of the fund who was the CEO of the company. So the outcomes were very much aligned because, he's kind of got one foot on the investor's side and one foot on the operations side in the company. So very clear messaging in terms of what they wanted to achieve and a clear timeline to achieve those clinical milestones. So very clean transaction from that perspective. And then the lenders, so this was interesting, even though we had a very strong team and, good management team, good investors, a large pharma potential buyout, we like to take these deals to multiple lenders to give our clients different looks at structures, terms and conditions, and help them decide what would be most beneficial. But we had a few of these lenders just pass on the deal because of the uncertainty around that acquisition date. What's going to happen if they don't get acquired? How is the company going to be carried forward? And so this is sort of speaks to why a broad process needs to be run under any circumstance when you're doing this type of financing, because oftentimes it's hard to tell at the outset exactly who's going to be interested and why. If we only took it to 3 or 4 lenders, we might have had 3 pass and 1 accept, and we'd have been stuck with 1 term sheet and not sure how to negotiate it. But given that we took it out to 6, we had 3 very, very much interested and 3 who passed for one reason or another. But lenders 1 and 2 really came in with the strongest terms. Lender 3 couldn't get the deal up to full ask of the $10 million. They could only come to somewhere shy of that. So it wasn't really a strong consideration there. But lender 1 and 2, they were competing against each other, and they kind of hammered it out to win the deal. Lender 1 really came in with incredibly strong terms, and to the delight of the company, lender 1 won the proposal. So very competitively priced to market, very flexible, with enough capital to get that company to get through the inflection point. The final terms actually met or improved upon every characteristic that we track in prevailing market terms. So it was a good deal really across the board. The funding contingencies for each tranches were negotiated for low hurdles, so to make sure the company could easily achieve that. And then, the rest of the terms were very solid, low cost of capital, almost no final fee, reasonable upfront fees based on market conditions, and almost no prepayment penalties, because that was a concern of our clients. Because they would be acquired, they didn't want their acquirer to have to pay all sorts of fees on the acquisition. So the lender came in and lowered their prepayment penalties. And almost the best part of this whole deal was that the CFO really was historically accustomed to working with a single lender. It's just, and this happens. This often happens that there's a long-standing, solid relationship, and the lender, is a good lender, and they do a good job, and they have a great reputation in the market. But it had been a while since he'd been privy to a competitive process, and he was pretty surprised to see what the results of a competitive process could bring to bear. Having worked with this single lender without competition for quite some time, it was eye-opening to him, and really kind of spoke to the process that we ran on his behalf. And we recently checked in with the company. They're ahead of plan. They're hitting their milestones, and everything's on track, and they're using the funds to maximum benefit. So it's a good deal all the way around, and a great example of stakeholder alignment there. So I'll pass it back to Rich to talk about, the benefit of historical context and how that actually helped us in that deal, understanding the market from historical context.
Thank you, Stefan. That certainly was a win-win comparison for both us and our client. My lengthy experience in the industry helps me really understand the market. It helps me project through different cycles what's going to be up and some of the trends that are in the market. However, you have to be careful that you don't get trapped by all this experience and go with your gut feeling, because you have to recognize trends and how significant it changes all these different market conditions. So we do a very careful statistical analysis of all the different term sheets that we gather, that we've been gathering, as mentioned in here, since 2003. Lending terms are very cyclical and dynamic in this space. It's not as comparative to middle market lending that really is decided by a few basis points. There are far more considerations in here and far more flexibility. The things that we're monitoring in the industry right now are things like interest-only period, back-end balloons, success fees versus warrants for the equity kickers. These are all things that are constantly changing and being modified. So what we were able to do with all these data points is we're certainly able to recognize trends and make sure that our clients really get the best terms and conditions available. What I'd like to talk about next is really our process. I've seen the debt selection process range anywhere from 15 to 90 days. We see to get optimum results, we typically see it falls in the 4 to 8 week range. Here's what some of the steps that we go through in our process that we've found help us achieve the best goals that we have. First, we take a consultative approach. Each one of our deals we recognize as being customized, and you have to understand that each company is different, and what's best for them is different. One of the other things that we find is many clients feel that after they've raised equity or with certain points in time that they should be using debt. About 30% of the clients that we go out and speak to, we've found after determining our runway analysis and impact on them, that debt is not appropriate for them at that stage. So we advise against that. So part of this consultative approach is to see if it's appropriate at all. If we decide to go forward with the deal preparation, we talk to the clients we give them a list of information that the lenders are usually looking for. And then we prepare an RFP for the different lenders of the things that will be compared in that the client is looking for. That allows the lenders to look at the deal before signing any kind of confidentiality statements. Then after that stage, we get to go out to the most important lenders, have them sign really confidentiality statements so they can receive the entire financial package that we are usually working with, which usually includes a business plan. Then we allow them usually 2 weeks to respond after receiving all the information. The reason for that is we want their underwriters to be actively involved at this stage, so any of the proposals we get will be firm and not subject to later change. Finally, we take a look at all the terms and conditions, outline them for our clients in a summary fashion, and talk about how we want to push back on all the available lenders that are there. Finally, we select the best lenders. The client typically sign a term sheet, and then there's usually a 3-week due diligence period before documentation comes in, and that's the final step. Why should you use capital advisors? The things that we've highlighted today, and I'll just go through them briefly in summary. The market knowledge we have with these 1,200 term sheets is unparalleled in the industry and really gives us the advantage of being able to negotiate better. We know this market better than the lenders themselves because of all this experience. We take a consultative approach. Everything is fully customized for each of our individual clients. That allows us to reach optimal results for each client, customization. And finally, the due diligence and independent counsel. Any of our clients really are under the scrutiny of their board and if they have any investors. And what we have is a deliverable product for them that they can propose and show to their board, and it would be available to any of the investors of the company, that shows their fully due diligence process. And finally, we are fully engaged by the client on their behalf to act as a registered investment advisor and their, again, fiduciary best interest. That's really the end of our topics today. I'll pass it back to Jimmy so that he can talk about maybe any questions that you've submitted during the thing, and we'll do a little bit of a Q&A now.
Thank you, Rich and Stefan, for that excellent presentation. So we're heading to our Q&A session. You should be able to ask any of the questions in the area in your module on your screen. Please go ahead and submit those questions. It looks like we received some questions, and we'll try to get to as many as possible. It looks like our first question, Stefan and Rich, why do these deals commend equity kickers?
Why don't I jump into that first, since I was a lender for such a long time. Basically, these deals command equity risk because of the fact that they are perceived as high risk profile. These companies do not cash flow, they don't have track records, and for any standard lender, that would be a no-no right off the bat. So what the concept that Equitech introduced in the model that's still used today back in the late 80s was that they would have an equity kicker on each deal, and those funds would be set aside in case there were inevitable losses because of the risk of the portfolio. And it's a structure that's still in place today after somewhere around 30 years later. Stefan, you have anything to add to that, as to the equity kicker component?
Yeah, well, so one of the things I mentioned earlier is that, you know, that's been an area that we've had many clients push back on. And so we've seen over the years, certain lenders take on success fees in lieu of warrants. So there's now more opportunity to find structures out there that are less dependent on the equity component altogether. And you know, the lenders will find their upside one way or another, whether it's through maybe a rate increase or some other sweetener in the deal. But yeah, I mean, there's a level of risk for early stage companies that's being taken. So the lenders are gonna find a way to get paid for that risk. But as I said, nowadays it's not always in the form of equity, but there's some other sweetener there.
Thank you guys for answering those questions. So the next question in the queue, Stefan and Rich, how much do investors' influence matter in the success of the transaction?
Again, I'll jump forward, having seen most of the venture debt over the years. I used to call it a three-legged stool, that there were three components that every one of these deals needed. The first component was they needed to have a year of liquidity to be considered for venture debt. The second component was that they needed to have institutional investors. And the third component was typically how strong was the management team. So each of these lenders would look at those three components, and the stronger they were in each portion, the more likely they could borrow and the higher that leverage would be. Now, that doesn't mean that without one of those components that you can't borrow. I've seen people borrow. I had a company on the West Coast that had 500 individual investors, no institutional, and we went out to the market and raised $20 million for that company very easily. So these are rules of thumb, but there's always exceptions depending on how strong a company is in different areas.
Yeah, it certainly does matter to a certain degree, but it's not necessarily a requirement. I think it matters most at the very earliest stages, as you know, through those, you know, Series A, B, maybe even C rounds. but obviously there's mitigating factors, and those include, well, I mean, access to public markets. So if the company's IPO'd, obviously the investors aren't going to necessarily matter as much. Also, any revenue or profitability. So, you know, that changes the consideration there for certain lenders. That doesn't put so much weight on the investors.
Great. Thank you again, Des. Looks like we have another question in the queue. The question is the venture debt that's done concurrent with an equity raise? Stephen Rich.
Sure, I can answer that. It's good to do, but not required. So a good benchmark that I like to give is that one of the early slides I mentioned, there was, 12 months of cash is one of those really hard requirements for companies that are burning cash. But then the other one is that you could probably borrow up to 50% of the cash on hand as long as you do meet that 12-month requirement. So doesn't necessarily need to be concurrent with equity, as long as that equity, whatever is going to get the company to where it needs to go. You can follow the equity with debt further down the road. It doesn't need to be exactly on time with an equity financing, but it is possible to run those two processes concurrently. So there are plenty of companies that I've worked with that where that's exactly why we get hired, because the CFO says, I'm running on a track toward raising money, whether it's private equity or public market equity. So I'm doing this, and you guys run alongside me and help support on the debt side, and we can close these transactions together.
And Stephen, you brought some very good points there. Let me just take the other side a little bit. I mentioned earlier in our presentation that about 30% of the people that we talk to initially, we end up not recommending debt. And I'll give you an example. So a company maybe is raising a large piece of equity and it's not tranched, might end up with 2.5 to 3 years of runway. Quite frankly, to add debt at the same time as they have that kind of runway, the debt provides very little value. So there's an example of where I don't think it makes any sense. You might look at it again 1.5 to 2 years later on that example, and it would make sense.
Thank you guys for answering that question. So it looks like our queue's getting a little busy. Another question that came in, Stephen Rich, since we are in a raising interest rate environment, are you seeing a corresponding increase in lending rates on venture debt, stream rate, like overall cost of capital?
I don't mind jumping at that first. Most of the deals we look at are pegged to interest rates. They're not fixed anymore as they have been in the past for the term. So they will be going up on each pay period, whether that be monthly or quarterly, and they usually peg to interest components, such indices that you can find commonly, like the LIBOR or prime rate. And so the lender is basically passing the interest rate risk on to the borrower. And we see that everywhere in the industry. So, and they do start at a higher benchmark now, again, because of the interest rate, which, again, I said the lender's passing on.
Yeah, that's a very good question. We've actually written a white paper on sort of the hidden costs of debt financing. And because while there are many more lenders than there once were 10 years ago, and a lot of these deals have become far more attractive from all other aspects of sort of the characteristics and components of these deals. The one piece that has gotten more expensive are these deals that are typically pegged to prime or LIBOR because they're floating. So yeah, I would say in this particular question, stream rates haven't necessarily increased, but they're moving. A lot of these lenders will put a floor on these rates. So should they go down in the future, they're going to peg on a floor. But yeah, as rates rise, the combination of that floating rate with the stream rate are making it more expensive for sure.
Great, thank you guys. The next question in our queue, Stephen Rich, will lenders generally always look to IP as security?
That's a good question. Again, like many other things, it's changed over time. Traditionally, when they looked at a Senior secured lien, which all these transactions are. The intellectual property was part of that. However, that became very cumbersome in the normal activity of an operating company. So what a lot of the companies do today is rather than a senior secured lien on the intellectual property, they give a negative pledge, which means they, in essence, they're not going to tie up that intellectual property. So that senior secured would still work through, but it's not a direct senior lien. They do get a senior lien on the cash, usually with a control agreement. Stefan?
Yeah, I'd say that's a general market trend. It's very lender dependent. So you'll see some lenders that will secure the IP. You'll see some that will carve it out via the negative pledge, but it depends on the lender, sort of the stage of the company, and also the industry that the company's in. It varies. Yeah.
Thank you very much again. So the next question or RQ, Stefan and Rich, how does CAG get compensated?
We get compensated as a success fee. So we believe that aligns our interests with the company. So we really only get paid out of the proceeds of the loan. And so that means that our client's gotten a good deal and they've closed on that deal and they've wrapped it up. And only at that point do we get a fee, which is a small percentage of the overall loan itself.
This goes back to what I said initially about being a registered investment advisor. We were only getting a fee, and we're working in the best interest as a team with our client, and we are willing to take the contingency risk that once we've engaged in a contract with a client that they will be able to borrow, and we basically get paid a percentage on that borrowing after they've signed loan documents. Great.
This question probably goes hand in hand to this prior question. Stefan and Rich, how long does the debt process take?
So the example that I gave earlier of that well-aligned deal, that was 5 weeks. So from start to finish, and I would say that was a particularly efficient deal. We were able to get through that quickly, but it's anywhere from somewhere just shy of that out to maybe 8 weeks in the process, and then typically once there's a winning term sheet, a winning bid, a proposal that's signed, then it goes to final due diligence and then final paper. So then the final docs go out, and we give guidance that might be 2 to 3 week process. I've seen it go longer, but it's around that time frame.
Yeah, I'd say on average it's somewhere between 4 and 6 weeks. If you want to negotiate the document further, it's going to take longer. But the due diligence period for the lender is 3 weeks alone, so that eats up a lot of the process.
Yeah.
I agree with that.
Okay, great. Well, looks like the queue is empty for questions, so I'll probably get back to everyone about 15 minutes of their time. So that will conclude our webinar. Thank you all for joining us today. We'll be sending each of you an email with a link to the presentation and Stefan and Rich's contact information. Thank you again for joining us, and have a great day.